I guess I don't really have a whole lot to say other than I think it's clear to everybody that the world has changed. Thank God, could hardly have been worse at certain times over the last decade. But the pace of change and the pace at which things have shifted probably is unprecedented, certainly in Ireland and possibly the world, I would have thought, in terms of how we have gone from being such extremists in terms of distress and so forth to a really rather buoyant economy. Not forgetting the fact that there actually still is a lot of distress in the market. We would certainly see it being sort of schizophrenic where transactionally our corporate team, which I head, and we have 8 corporate partners, we have probably never been here. But we'd be very aware that some of our other teams are working very hard in some of the workout stuff that's ongoing. So there is still a big and very significant issue in terms of unsustainable situations that need to be resolved. I guess tonight is more about the upside, and we're delighted to have our guest of distinguished panellists. I will allow Pat to do the intros in just a moment, and it leaves me with nothing further to do than just hope you enjoyed this evening. We'd like it to be interactive. It's intended to be such, and any questions, please feel free. The panel here are of no use to anybody unless they share their insights. So whatever you need to know, that's why they're here. So without further ado, I'll hand over to Pat.
So good evening, folks. Very much non-presentation format is what this is about the real world of people who want to lend money and borrow money and how do you go about it. But the structure we did put on it was just, if you like, to get some tips from the advice. A number of people here are advisors in various shapes and forms. So it's about getting tips from advisors on what's gone wrong in the past and how SMEs have been unsuccessful, if you like, in getting debt and or equity, and go through a lot of logic on that and get some market information from it. And then I suppose the interesting side of the evening is that we're actually introducing two new participants in the alternative funding market, one on the equity side and one on the debt side and the smaller scale finance. So hopefully you'll appreciate the blend of what's going on in the market and what's the advice, and then hear from two players who are actually going to give alternatives for the people out in the market. So if I may, I just go through and do a quick introduction of each of the panel speakers. They'll say a couple of words, and we have, to a certain degree, you'll see on the sheet with the logos on top, we've given them, or they've chosen a kind of chosen topic of interest to them based on their skill base, so that might just inform you as regards who you need to, or would like to ask which questions. So just to kind of kick it off, in terms of, first of all, thanking Byrne Wallace for arranging the venue for us and doing a joint invite list and really joining up. And I just wanted to maybe just say briefly, for those of you who haven't come across the CAIM Byrne managers, we are a special interest group in the Institute, members working in business and with business. We're not in practice, we're not competing with the accounting firms. In fact, our model is very much to work with accounting firms of various sizes as referral partners, either as interim managers with some of the larger firms where we go into placement in maybe a client of a top 20 firm where a client is having some problems, and rather than sending a senior manager or a director out for a couple of months on site, they get one of our guys to go out, get the turnaround done, get the situation organised, get the refinancing set up if that's what needs to be done, and they continue to have a valued, profitable, viable client, and we get some interim management revenue out of it. I suppose the other side then, where we have done and hope to work more with smaller accounting practices and legal firms and other advisors, is where with the current trend of compliance requirements and CARB and whatever for the smaller practice, it can be quite difficult where they have client companies that need some fresh finance or need to look at what are the alternatives in the market, where the alternatives have grown dramatically, but it means it's more complicated to find the match for you. So we're hoping to work more with the smaller practices to maybe give them insights into where's the quickest way to market and where's the best combination of lenders or equity participants for them. So that's really the interest of the CA Interim Management Group in the market, and the fundraising piece stands out for us on the basis of, I suppose, our prognosis is, as I had the temerity to put down at the end of the front sheet, is our rough prognosis would be that there's quite a wall of alternative funding in various shapes and sizes available. Our sense is that the percentage of the lending targets being set versus what's been achieved would be quite low, so there's plenty more lending to be done. And on the borrowing side, there's unprecedented demand for borrowing, but some of the information, and Jim Deeney who works with the Credit Review Office may give us some insights, is that the success rate in those guys getting their requirement filled in the market is slow. So we see, if you like, a reasonably dysfunctional market where there's more money available than there's deals happening, and there's guys going to the wall or coming under pressure for the lack of funding. So that's really, I suppose, our scene set. So if I may then, I'll just go through, and maybe Mark, I'll just ask you to give the Byrne Wallace and the, if you like, the legal expert view on where you see the requirements in the market and what you can bring.
There is a huge influx of alternative lenders in the market. I think there's a great gap in the market at the moment. There's big opportunities for people like sitting here on the panel today for the businesses they represent, because there is a shortage of credit, as you can see at the moment. And one of the things that we see, the kind of obstacles to borrowers getting credit, and we act for all of the main pillar banks, we act for NAMA, we act for a lot of the alternatives that have come in. And what we see is kind of a lack of preparedness is one of those obstacles to borrowers coming to and obtaining finance. We see if a borrower is prepared, so if they looked at if they know they want finance, they need to make sure that their accounts have been filed, that the company's register is up to date, the shareholder register is up to date, that the CRO reflects what the directives that are actually in place. If they're looking to raise finance on assets, equity or IP or whatever, that the appropriate licenses are in place, that the title stands up and is good and marketable, and that they've done their homework in advance. We have a couple of kind of recent examples. We acted for Griffin Hotel Group last year, and this isn't in any way a secret. It was in all the newspapers. They refinanced their debt very quickly. Their loans had been bought from Ulster Bank by Sankati, and they were under huge Sankati culture funds, as you probably know, had given them a couple of weeks basically to refinance, or had given them a very hard deadline to refinance. A lot of pulling and dragging, but they had a really good team in place. They had a really strong CFO who had done an awful lot of the groundwork, who was able to present a really nice package to AIB funded it. I think that you might have seen last year SME Finance Deal of the Year. And the Griffin Hotel Group, they managed to get that deal over the line, I think, from start to finish within about 6 weeks. And it was a huge team effort on their side. They had their titles all lined up, they had their accounts all properly set up, they had everything done in advance. And we have had the opposite experience then, with Virgo, acting for the purchaser of the company, where the due diligence process went on for about 6 months because the vendors hadn't got their information lined up. So anytime you asked them for a copy of a license, a copy of a consent, they had to go up and get it again. So the funders were getting very fed up, and patience isn't there anymore. So I think that's probably one of the key things that we see in terms of the fact that Benjamin Franklin fails to prepare to fail. Is that maxim, I think, is one of the things that we see.
Thanks very much, Mark. What I do then, in terms of just the brief introductions, if I just turn to Jim Deeney then.
Yeah, just in terms of the Credit Review Office, it was set up in 2010. It was set up as part of the NAMA legislation, and the function of the Credit Review Office is to provide an appeal source for SMEs that have been declined credit by AIB, Bank of Ireland, Ulster, and now Permanent TSB have come into it. So it's they deal with, we accept appeals for amounts up to 3 million. It started off at 250,000 and it has been increased over the years to 3 million. And Interestingly enough, before an appeal can come to the credit review office, it has to be obviously refused by the bank. Then the bank have, similar to the mortgage process, they have an internal appeals process, so it's got to go through that internal appeals process as well and be declined again before it comes to the credit review office. And it's quite interesting, the statistics so far this year is that of those credits that have been declined by the banks, their internal appeal actually overturned 24% of them. And of then those that are still remain declined and come to the credit review office, the credit review office have overturned 54% of those. So when you look at those statistics, it just goes to show how in an exact science lending to small and medium-sized businesses is. And I would say in terms of what we see coming to the credit review office, it's only a fraction of what has been actually turned down. Because banks, if a business customer goes to a bank and says, look, I'm thinking of buying my premises, and I'm just wondering, would the bank fund it? I need 80% finance. They could very well be told over the phone, no, sorry, we only do 70%. Now that's a refusal, that's a credit refusal, which can be appealed to the credit review office. In that situation, the bank should be actually writing out to their customer saying, we've declined your proposal. But that actually never features in any statistic at all. So the credit review office, in my view, is completely underutilised. I think we're to blame partly because we do advertise on the radio, but I think we could do more to make people aware. There's one person in the audience here who has had a recent experience of dealing with the credit review office, and it might be useful for maybe them just to tell you what their experience was for their client, which I think actually was quite satisfactory, but to give you an independent view of what it is. There's a minimal charge to lodge an appeal with the credit review office. It's a maximum charge of €250, and that was put there purely and simply to, I suppose, stop people sending in frivolous sort of appeals, but that should never be a reason for not putting in an appeal. So, as I say, we probably have a lot of work to do in terms of raising the awareness. But I don't want to, just in terms of some of the things that we see in terms of applications, and maybe Patrick, if we can do that later on, maybe talk about that.
Yeah, I just want to give the room a feel for who, so we'll definitely come back to that one.
So my name is John Bowe, I head up corporate finance with Mr. Pat asked me to talk about the banking markets and the debt markets and what we're seeing. In my view, I suppose you split it in two. You look at corporate banking, and actually we're in a pretty good place. Pillar banks are all lending. Pricing is actually pretty competitive. International banks are all there. Leverage levels are good. So we have a fairly functioning corporate banking market. On the business banking side, I mean, it's very dysfunctional, is how you describe it. All of you will have experienced it with your own clients, and we certainly have with our clients, of being really frustrated by the business banking process at the moment. And part of it is a bit of a disconnect between the relationship manager and the credit process. So you go in with your client and you meet the relationship manager, and he gets a sense that this looks like a deal we should be doing. They understand that it's a cash flow lend. They take it to credit, and credit will come back and they'll have questions on it without the quick no. And for me, the quick no is really important for all of us. So you spend another couple of months with that slow no, which is really painful for business owners out there that want to get on with running their business. Where do I see the issue? If a business owner is looking to make an acquisition and it has cash flows in his own business that should support that acquisition in terms of a lend, I think there's an issue with the business bank not really understanding cash flow lending. They look at the acquisition that the person is acquiring and they still say, well, you need equity in that deal. And what they mean by that is, where's your skin in the game? And we as advisors, and I'm sure you're in the same boat, will turn around and you'll say, well, actually the equity you're getting is his business is worse. That's his equity. I mean, he's there with a business that has a value, that's equity in the game, because you're taking security over the asset he's acquiring or the business he's acquiring and his own business. And the issue, I think, is business banking don't really understand that really well. I will caveat what I say, and I touched on it with Chris earlier on. It's very important that the relationship guy on the banking side is an advocate for your deal. And this is where I tell people, if you can get the sector specialist to the meeting with you and become your advocate for the deal, your chances of success go up. And that's a good thing in the bank. They have sector specialism. Make sure you're getting your clients in front of the sector specialist. They'll become the advocate and you have a better chance of success.
I head up strategic growth leaders, and we have a couple of members who are co-directors of mine who are here. And we work closely, particularly with Enterprise Ireland, on the fundraising journey and the strategy journey with a number of their clients. And I suppose, particularly from a funding point of view, what we're seeing is, and probably most of you in this room will be delighted to hear me say this, but we see a huge capability gap within the companies that we deal with. There's a resource issue, but there's also a huge capability issue in terms of getting the company to a point where they're ready to take on investment. They either understand the process of getting to the point at which they're ready to take on funding, and they also have a lack of understanding of what the process is in raising the funding once they're ready to go. And it is becoming rapidly, the awareness of this issue is becoming rapidly evident at the moment amongst all the agencies. So with Brexit looming, we've seen a huge issue there in terms of the lack of planning that is there with companies in terms of Brexit. Now, albeit there's limited planning you can do at the moment because we don't know what the outcomes are going to be. But it is that resource and capability issue that's there most EI clients. One other thing is that in my guise, I was also founding chair of IFB Ireland, the umbrella body of the non-bank sector. And it's the interaction, just following on from John, it's the interaction between the traditional banking sector and all those alternatives that are out there. And that interaction is starting to happen. There is interaction where the big issue with banks was the all-asset debenture and the PG. And the all-asset debenture was creating unbelievable cash flow issues because obviously, if you have a debtor book that's wrapped up in cotton wool, you can't release it if there's a cash flow shortage. So if a company's getting cash out, they can't release the debtor book. So banks are now at a point where they're now prepared to release things like the debtor book if it's not necessary. And we've done it a number of times now at this stage where we've convinced some of the other banks to release those debtor books. So there is a little bit of engagement. I wouldn't like to be kicking the banks totally. There is a bit of engagement, but we've a long way to go on.
A guy I've done some work with, and he's the strategic advisor to the board of BCRS loans. He'll give you a flavour for what he's doing with them and what their plans are. So I hand over to you, Ray, if I may.
Thank you. So BCRS are a UK-based CDFI, that's a community development financial institution. They cover an economic area equivalent to Ireland, and their plans are to grow to 100 million in lending per annum. And we've been part of that strategy is to look at, because of Brexit, is to look at alternative markets, and we've been looking at the Irish market, and we see wholesale market failure here. But just a little bit about BCRS. They're quite unique. One, a not-for-profit lender. That's pretty unique. A lender whose objective is to protect employment, increase employment, and stimulate economic activity. That's pretty unique too. And they've been awarded, they're regulated by the FCA in the UK. They've been awarded one of only 3 lenders who've been awarded by the European Union, the top accolade for responsible lending. And they're up for an award for the best UK lender. So it's a very interesting model. The plan for Ireland is to lend between 25k and 250k. It's effectively growth capital. It's a relationship management based model. It's character based lending. It's not about the computer says no. It's actually let's go and meet the guys. And the model is not to lend to startups but it's for businesses which are viable. And what we're finding here in the Irish market is that lots of viable businesses don't draw down on debt because they're not able to. And some of that's for various reasons. They've missed a payment or whatever else, or it's outside the bank's appetite. We will be slightly more expensive than the banks. We're not competing with the banks. We will work with a number of lenders, and effectively where a lender's risk appetite goes to a particular point, we'll take over. And in the UK, the way the model developed, it was initially, when the business set up in 2002, it was we could only lend to organisations which were declined by the banks. It's not that more expensive, and certainly, we feel that the level of market failure in this market is actually quite significant. We're working quite closely with the pillar banks. We have an MOU in place with one of them. Probably we'll have one with another one fairly soon. We'll work with on Post. We'll work with credit unions. We work very closely with Microfinance Ireland to basically get money out into the market. We expect, typically in this type of market to probably have a bad debt rate somewhere between 20 and 25%. This happens. It's very hard to tell who's going to be bad debt or not. That's the issue for a lot of the banks. So it's we're looking forward to getting into the market, and certainly the ethos is to lend as opposed to not to lend.
So it's real hot off the press stuff here in Byrne Wallace tonight. So if I hand over to you,
you're in big trouble for that, by the way. That's the first paddy these guys have employed. It's a bugbear of mine to make sure that one disappears out of the national narrative. But helpfully we've rebranded as BGF, and so there's no more acronym. It stands for nothing. It's just BGF, and that suits me just fine. A very brief history lesson, just as what is BGF and where did it come from, if I may. And it's a UK story, clearly in its origins. 2011, the depth of the financial crisis. The five main clearing banks in the UK came together in an enterprise with the support and the encouragement of the British government to put together a pool of capital to deploy into the UK SME sector. Because there was a view that the UK SME sector was under-capitalised and there was a need for equity, but not traditional private equity. The equity that was needed was non-controlling equity, growth equity, to support entrepreneurs and family businesses that didn't want to give away the crown jewels, so wanted to stay in control of their destiny, but needed capital and didn't want an over-reliance on bank debt. So by all means, a sensible level of leverage in the system, but not an over-reliance on bank debt, because that's what got us into trouble in the first place. So £2.5 billion of committed capital later, 180 deals executed with family businesses and entrepreneur-backed businesses in the past 5 years. So a lot of volume and a lot of hard work. Headcount grown from 30 to 150 and increasing. So far, so what? We're repeating the trick in Ireland, and in a month's time we're going to announce a dedicated Irish balance sheet, not a fund. I'll explain the difference in a second, but a dedicated Irish balance sheet to invest in Irish SMEs on exactly the same basis. And what kind of investment we do across all sectors of the Irish economy, apart from property. So we've invested in house builders, invested in nursing homes, retailers, restaurant chains, export businesses, craft gin, a whisky distillery in Waterford called Renegade, Battery, a waste business up the north, and a house builder in Derry. And we haven't even launched in Ireland yet. So these are just some of the things that have happened virally almost, and through contacts and so on and so forth. The size of the balance sheet will be reviewed in a month's time, but it's very sizable. It's dedicated to Irish businesses with some very significant Irish stakeholders in the background, so it does have the support of the establishment, for want of a better word, and there's a bit in the papers about all of that. So, look, I think it's very exciting, and for three reasons. Firstly, it's strictly minority, so we're absolutely not out to take control of business we invest in. It's 10 to 40% full stop, with no strings or sneaky clauses in the legal agreement that say if you don't deliver on the business plan, we'll step in and take 80-90% of your company. There's none of that stuff. If we're in, and we're all in it together until the end. The second thing is that the terms we think are management friendly, and the whole approach is partnership. And it's a very small example relevant to, I think, your world, Pat, is when it comes to due diligence, instead of sending in an army of accountants from one of the big four firms to do a full A to Z and break the company in two under the burden of the due diligence. We think there's a whole lot more value as a minority investor in sending in an experienced finance director from industry who, on a nil liability basis, spends a week, 3 or 4 days with the management team, the founders, hangs around the business, comes back to us with a very punchy and honest report and says views on the people, are there gaps in the team, to your comment earlier, and there usually are. And if they're deep and extensive, maybe it's not investment ready and we should come back to that theme. But if there's 1 or 2, we can take a view on that and we can help as part of the investment process to shore up those gaps. And they'll give views on, if you were to continue with your investment, you might want to look at this area, that area, that's fine, and then you can send in the reporting accountants after the fact. But so it's the second piece, minority, management friendly, and thirdly, because we're an evergreen balance sheet, we don't have a 5-year restriction in terms of getting our money back like most fund structures do. So it's not a fund, it's a balance sheet. That means we can invest for the long term, and that means when it's the right time to sell the business, if indeed it ever is, then that's fine by us, and we'll go along with that. And we've no, without using jargon, you guys understand it, we've no drag right on the founders of the business, and typically private equity does. Because typically private equity says, if there hasn't been an event at the end of 5 years, we're taking over the reins here, we're going to drive the bus. And that's fine for some, and that can suit some people to let go of control of their business. I suppose our pitch is, you don't have to do that, there's another way of doing it, and it's about to become a part. So that's a long-winded intro, but forgive me, I always wanted to get the sort of context out there.
The lending side. I'm just wondering, when you both put money into an organisation, do you, it's one thing the reporting sort of after the fact about how money is being managed, but for example, do you participate through membership on boards or anything like that?
No participation at all. It's up to the company to do it, and as long as they're repaying it, and if they have problems, they just come back to us and let us know. We can reschedule it, but there's no, we don't have any penalties for repayments. We can go up to 10 years, so it's just a very flexible process.
And we do, and for obvious reasons, and it's of course, once again, as an equity investor, you want a seat at the table, absolutely. So we'll take a seat, and we'll also insist typically on an independent chair coming on board. That's a really important part of the deal process for us. And if there isn't buy-in around that in the funny kind of way, that can be a real problem. I mean, minority investing, as you guys, ladies know, it's about people, because clearly, if you're buying a business as a control investor, well, you're buying a business, and then you can do what you want afterwards, and that's fine. But as a minority investor, you're backing a team of people. So, and I guess it's just a protection. If it's a family business, you don't want to be ganged up on as the minority investor. There's a whole lot of good reasons. It's not just selfish reasons why you want an independent chair. So, but it'll be somebody that the business respects. It's a mutually agreed person, because it doesn't work if the founder, the CEO of the business doesn't respect the chair, which you're wasting your time. So it has to be somebody of a quality and a calibre that A, is respected by the founder, and B, is respected by us, and is prepared to not just sort of tick the box, but also roll up the sleeves a wee bit, because SME, the comments were interesting for our colleague here earlier about the work that's needed. SMEs aren't neat and tidy. They don't come presented with a ribbon and a bow. They're usually diamonds in the rough, and that's the beauty of it. That's the fun side of it. But there's always a lot of work to be done, and the role of the chair is, we think, BGF is hugely important.
So rate was 25%, did you say, in terms of your book?
So that's our projection for the Irish market.
Yeah.
In the UK, we're running around about between 8 and 10%.
So that seems very good. That's a very high rate in terms of how do you make a return with the margins and.
Well, the model is the funding comes effectively from Europe. So you've got both the guarantees, and 50% of the funding tends to come from European funds. So in Ireland, the starting position tends to be 50% from the Strategic Banking Corporation of Ireland, and the other 50% from the markets. We have the advantage that we can have anything that's raised, for example, in the UK through the sector gets particular tax advantages. So, for example, we put together a deal recently with Santander, and they reckon that they would have to have a default rate of 52% before they'd actually lose any money. So we use some financial engineering and backed with European guarantees and a few other things. It's not as crazy as you might think. Interestingly, Ireland is probably one of the worst, in fact, it's one of the lowest countries for actually drawing on the European funds for SMEs, whereas the UK is number one. So it's a well-proven model.
Question for Dr. Ray. You mentioned that your funding would be more expensive than the pillar banks. How much more expensive, if you can give any sort of...
Yeah, sure. In the UK, we're not that. In fact, sometimes we're actually cheaper. But based on the expected bad debt rate, the average is probably around about 12%. If it's secured, it'll be less than 12%. If it's unsecured, it'll be slightly higher. But it's around that, and there's no tricky bits in it. We don't look for personal guarantees or anything like that. Yeah.
I might just pop in a question there. Jim, in terms of, Jim's colleague Barry Mother was supposed to be here tonight, but he went under the knife for a knee operation yesterday, so Jim is multitasking. We had Barry Mother in and the interim managers just giving us some feedback on, as a debt advisor, what are the typical mistakes people make and why do their lending applications get rejected. So I suppose, Jim, from your general duties and then the CRO, what would be your main finding as regards what lenders are getting wrong and causing them to fail to get their extended or renewal of their lending?
Yeah, and I agree with the previous comments there about the banks and these unending requests for additional information as part of the application process. And a large part of that comes down to the fact that the quality of the credit application that goes into the bank nowadays falls far too short of what the bank require. And in the days of walking into a bank and sitting down across the desk from the branch manager and verbalizing your credit application is long gone. So people have to invest time in terms of covering off, the key things like the business model, the management of the company, the financials, the historical financials, forecast financials. Also being aware of what the bank's policy is in terms of repayment capacity and the types of repayment interest cover and repayment cover and that the banks look for, the security and that the bank is going to look for and be aware of their security. So putting a comprehensive proposal to them that ticks all the boxes, at least then, you should get hopefully, perhaps a slow no, but at least you should get a fairly quick response. There is, and again, is another area that is, the banks don't comply with to a large extent. There is regulations around how long a bank should spend processing a credit application, 15 days. They don't adhere to that. They're required under the regulations to write to you, like for example, the Ombudsman's office or our complaints department are required to write and say, look, 15 days, we're still assessing the application. Most of them don't do that, so they're not adhering. So push them on things like that, and but the quality of the application going in, we find as well is that when people go in to meet a business manager, there's a lot of inexperience now at front end in banks, and they don't just have the experience to probe and to ask the questions and to find what I call the hidden nuggets. And I find in the credit review office, part of our process, when we get an appeal in, one of the things we have to do is either meet with or talk to the customer. And it's incredible when you start asking, probing the amount of information that you get that hasn't been on file. And one of the things we come across most when we go back to the bank and we recommend that the bank provide the finance, the bank will say, oh, well, hold on, you've got information that we didn't have, and we're now prepared to do it. So there's that lack of sort of experience, or even a lack of willingness to probe and make a deal out of perhaps an application that doesn't look like a deal on the desk.
Thanks, Jim. Listen, John Lowe, I might just follow on that one and just touching on your comments earlier. What, if anything, is your view on the level of cash flow lending understanding of your typical banker or traditional banker, and what can the advisors and the market do to put pressure on to improve that scenario?
I think in terms of understanding, I think that's a challenge in some places. I think the business banking, if you look at what happened, they probably during the downturn lost a lot of good people to equity funds and debt funds and other alternative funders that came into the market. So that's a challenge for business banking. I think they are trying to address that with sector specialists, and you know, it has worked on a few deals we've worked on. I mean, you know, it's important to say that there are options out there for businesses in terms of the other debt funders in the market. So, you know, from an Irish context, we've never had so much funding in the market. I mean, it's great to see on the equity side all the equity funds that are out there, but we also have a lot of debt funds that are lending in terms of, and various pricing. So we've Dunport, which is Blue Bay, we've Preventus coming in, we have BMS, we've Capitalist Debt. You know, there's a lot of options out there for people, and you know, for your clients, you know, while we all want to get our client the cheapest possible price, I actually sense that clients really want to do the transaction and they don't want to miss the opportunity. So, you know, to run parallel processes is probably important, i.e. run a banking process and see where you get, run an alternative debt process in parallel with that. And you know, the one thing I'd say is these funders, these alternative debt funders, you are talking to the decision makers effectively. So, you know, you'll get a very quick response. The actual due diligence process still takes time. It's, you know, they're not that quick in terms of, they still have to go through their exercise and due diligence and making sure that's okay. But, you know, 90% of the time the term sheet you get is what they'll deliver, and you get that term sheet within weeks versus a banking process. And then at least you're giving your client options. You know, here's an option on the table, we can get you the money quicker, and that might suit you in terms of what you want to do with that funding, versus the banking process, which is just going to take time. And you know, all of us have experienced that banking deals are just taking much longer to close.
Just briefly, in the context of the alternatives, have you got any advice or insights as to how someone who has a pillar bank relationship, that, you know, that's whatever huge percentage of the market, tips for them how they can bring an alternative source in and work with the pillar banks and get a resolution?
Yeah, I think John touched on it earlier in terms of trying to release a debtor book for working capital and working with your bank. You know, the debt funds typically, and I think it's something that will mature as they become more relevant in the Irish market or are here for a longer time, that they should sit beside senior banks in the capital structure. I think if you look at the US market, you know, senior banks, debt funds, equity guys, all participate in the capital structure of businesses. In an Irish context, we still have either the senior bank with all the security, or the debt funder wants all the security and wants to take the senior bank out. I just think as that relationship matures a bit, we should be able to sit alongside each other. We do see MES products used, so there are MES funds that will sit behind a senior bank to increase the leverage, and you know, there are MES providers in the Irish market as well.
Great, thanks, John. Maybe Mark, if I come across to you, I mean, what we talked about the snags, I suppose, from a finance and presentation perspective. What are the most likely things to hold up a deal from the legal perspective? So if you're looking at a transaction, what's the block points there?
I think it's kind of simple things often, so it's not the kind of complicated loan agreement. I think with the emergence of the alternatives, the loan agreements have become possibly more sophisticated and longer before, but it's often the simple things. It's the KYC documentation that the lender's looking for. It's trying to open a bank account. I don't know if anybody's had experience trying to open a bank account recently, but it can take months. And it's those kind of things that are really holding up transactions. Insurances, if it's a property related transaction, the insurance details become just a nightmare for everybody. And the lenders all have particular requirements that don't necessarily get dealt with until very late in the day, and then they hold things up. Where we find that, say, if there is a senior lender in there and you're trying to release equity, or you're trying to bring in a MES funder, it's getting that consent early, it's getting redemption letters, it's getting an agreement around how the security will be shared. It's those kind of things that we find are holds transactions up.
And in terms of your experience, in terms of getting the legal firm involved early enough to make sure that you're actually trying to come up with a combination with the right structure, what's your finding in terms of the timing of the involvement?
I'd get them in day one. I think the earlier we're involved, obviously, I would say that, the better it is. I suppose there are people that specialise in this area as well, and more than the guys on the panel or you guys. I think if you operate in this space all the time, it becomes easier to navigate. So I think that if you have people that have the experience of acting for lenders or acting for borrowers in the various capital stack steps, whether it's debt, equity, mezz, senior, I think it helps to navigate. So the earlier you get people in or get financial advice or corporate finance advice, I would say the sooner the better. And I go back to that Griffin Group example. They had corporate finance advice from very early on. They had engaged lenders or lawyers early on, and they engaged with the banks very early in the process. So if they knew there was a deadline out there, they had done all the prep work and they had got the advices that kind of saw them through and got them to deliver the deal that they needed in a very short time frame.
This type of, and we have lots of new alternative lenders, but do you see further changes coming in the market and how it functions going forward?
Yeah, I mean, that's a very good question, man. It was often said that if banks lose payments, they're in serious trouble, and that is starting to happen. I think that you've now payment providers coming in like Fire and other payments. That the payment sector is really key for banking. In the alternative space, I would comfortably say that we probably have operating in Ireland now somewhere between 40 and 60 operators now in total if you were to cover the entire market. It's virtually impossible for a single company or a single individual to navigate that whole space. So I think it's going to become key for organisations like CAIM and some of the advisors to be the familiar, to navigate this space for individual companies, because it's evolving at such a pace. It's impossible for anybody to keep abreast of what's going on. You've lenders going out, you've new ones coming in. You'll read on the news of someone having declared insolvency because they could not, and then there's a new one coming in a week later, and that seems to be a common theme at the moment. So it's a very, very fluid environment at the moment. Is it here to stay? Yeah, there's definitely sectors of it that are absolutely here to stay. The unitranche lenders, going back to your point, John, the unitranche lenders, I think, have to be unitranche because they have no other way of entering a deal except by taking out the pillar bank. Hopefully that will change, I think, and they will sit under the bank in terms of capital structure. The days of 100% lending for the bank are over. We're now looking at 50-60% is where the bank will sit, and then you go out and find the rest from the colleagues on the panel here beside me. So it is here to stay. Personally speaking, I do think the banks will catch up, but it's turning a tanker. It'll take so long for them to get their house in order, to have the skills in-house to be able to do it, to develop the products that are necessary. And like some of them are very simple. Like, such a simple product like single invoice financing. It's such a simple product, yet the main banks can't deliver it. And it's the shortest security, it's the most easiest to secure over, and yet they can't do it. So there's your typical. So it is here to stay.
Very good, thanks, John. Dr. Ray, just in terms of, obviously, conscious you have your involvement with BCRS is coming from their Brexit, partly from their Brexit strategy. I mean, have you any other thoughts for the room in terms of, SME funding and fundraising, survival sector, Brexit type of funding issues as distinct from strategic issues that the room need to be conscious of?
It's a major area of worry. I chair, on behalf of the Competition Markets Authority and the two financial regulators in the UK, the Nesta Prize, and I also, on a quarterly basis, moderate the 19 Eurozone central banks, and the implications of Brexit are very worrying. At an extreme, we're hearing that, or from various commentators, that Brexit could bring about in certain jurisdictions, another banking crisis because of the dependence of the economies on the SME sector. Consequently, we've been working with the SPCI in designing a Brexit product but Brexit will undoubtedly create major business challenges for the SME sector, and I think it's incumbent upon governments and the European Union to help those organisations weather the storm. And that's why we have the European Investment Bank. That's why we have the regional structures, and it's really important that governments and the banks engage with it. I mean, I know if you speak to the Banking Payments Federation of Ireland, they will probably echo the same sentiments, and certainly it's a major concern. And I guess from a Brexit point of view, some of our, we're doing ongoing analysis of, no Brexit or whatever else, and I guess it's very worrying that when we speak with banks, they really haven't assessed the impact of Brexit on their customer base, and very often lots of larger organisations haven't actually looked at the implications for the supply chain or whatever else. So it is a major issue, and unfortunately we don't have a terrible lot of time. I mean, organisations think we have 18 months left. Well, that's not true. We actually only have 12 months, and actually when you actually look at it, in depth, the amount of time available to do something is quite short. So it is a major worry. I don't have a particular answer on it, but progressive. I mean, I have to say that the Irish are doing a good job. I spent quite a lot of time with them looking at the issue, but there's a lot more to be done.
Thanks, Ray. Leo, just I don't know if you, from an equity investment perspective, with a fairly broad appetite in terms of what sectors you're willing to invest in Ireland. I suppose the easy one for me is how do you see yourselves taking minority stakes in food-based SMEs that currently export to the UK? So what's your kind of view on the doability of some of your lending?
As the Irish politicians said, that's a good question, but I prefer to answer a different one. Look, when it comes to Brexit, there's people much better. I think perspectives are interesting, and there's people. We've all sat at the round table events, and personally, I struggle a little bit with some of the negativity, and that's not for a second, any kind of a prediction around the impact of Brexit, because clearly it's deeply unhelpful, and that's a real problem. That being said, on the ground in this country, I think the mood music is very positive, I have to say. I think there's great energy in this economy. And sometimes when you're in Ireland, we're great at the negativity sometimes, but a lot of my colleagues were over from the UK this week, and just walking through Dublin, they said it's pervasive, that sense of energy and optimism, and there's such a vibrant entrepreneur class coming through in Ireland, and with businesses, many of which transcend Brexit because they're technology-based businesses, and they're not even thinking about land bridging into the UK, they're just thinking globally, and we're meeting them all the time, and that's not for one second to diminish the comments that Dr. Ray said, but it is just maybe that counterpoint piece which says, things are pretty good right now. Prior to this role, I was doing what John is doing, sort of the hard yards of corporate finance up and down the country for the last 17 years, and I remember lots of really difficult times and very fallow periods, and I have to say, certainly based on what's in front of us right now, as we look into next year, the activity in the law firms, the accounting firms, the corporate finance community, the amount of funds, the amount of investment activity that's going on, it's good. So that is answering a different question. I'll make no apologies.
Just while you have the mic there, I'll give you a softer pass. In terms of your interest in doing minority stakes in family businesses, I mean, what's your insights into how you do that well? Because I sold you with one particularly complex family business for a couple of years under a threat of a pillar bank, so it wasn't particularly great fun. But what's your view on how you guys bring value to those family businesses?
That's a very good question. I think once again, it's horses for courses. I think there's certain kind of family businesses that are multi-generational and steadfastly independent, and they're doing very well, thank you very much, and they don't need anyone's help, and they're flying. And that's great. There's others that maybe it's because there's three brothers and one of them wants to step back for whatever reason, or it's age, or it's sickness, or it's tiredness, or whatever it might be, and the business, there's a gap that emerges, and there's a need for equity alongside a sensible level of debt. And I keep saying that because this isn't about one or the other, this is about doing the right combinations across the capital structure, clearly. But that's where maybe it's the more progressive family business that say, look, we brought the business to here, my father brought it to here, my mother, and we want to kick on with the next generation. We want to kick on from here and move into that next country and make an acquisition for the first time, and so on. And there's lots of those family businesses around the country, and maybe that's fertile territory for us. And I suspect it will be, where they won't come rushing in the door and saying, dilute me and take 30% of the family business, and that will never happen. But they might say, tell me a bit about how you can add value and how does all of this work, and and they might think about it, and they'll probably think about it for quite a while. And John will know this. The incubation period in the UK on those types of deals for BGF is about 12 months, where it's you meet and you meet again, and then you wait 3 months, and then they pop up again, and then you meet another time, and this time there's an advisor in the room, and then you're getting warmer, and so on. So doing the deal is actually the easy bit at the back end, because if we get comfortable with the alignment of interests and with the people, and if they get comfortable with us, then actually the due diligence is 3 to 4. I mean, it can be 3 to 4 weeks at the back end. The hard part is getting to that inflection point where the stars come into alignment. But not easily done, and probably harder than entrepreneur-backed businesses or professionally management businesses, obviously.
Right. I suppose the question is pretty resonant for the members of CAIM, where we're dealing more with the turnaround and the re-energizing rather than the black box, high value IP guys who are have venture capitalists hovering all around. So it's that market where the people are currently employed and may not be employed in the future if they don't get funding, is I think where we are hoping the market will continue to focus on.
I think the crash, there's an opportunity, it's good and it's bad, because the businesses that came through, and some of which have the scars on their backs, it's probably a recognition that trying to go alone can be a lonely place, and over-reliance on bank debt maybe isn't too sensible if you're a progressive and fast-growing SME, and maybe you should think about alternatives. That's the good side. I think the bad side of it is there's awareness. I think there's awareness and a suspicion around, funds, vulture capital, private equity. You're going to try and steal my business, and that's the challenge for us, is to get the message out there that actually there are genuine, long-term establishment-backed initiatives that actually genuinely are trying to help SMEs, and of course we're trying to make money alongside the people we invest in. It's but at the same time, it does what it says at the tin, and there's nothing to be afraid of, and it's a win-win for everyone if it's done properly.
The question for Leo. Leo, you talked to the due diligence process and the person that you put in for short term to get an understanding of what the gaps were in the organisation. What sort of gaps have you been identifying in companies that you've been engaged with?
Yeah, very good question. You won't be surprised to hear that, look, if you think about the typical construct of the SME, you have a strong driver, whether that's a brother or sister, an entrepreneur, and that bit is usually you're trying to manage and rein that person in and bring them on a journey with you and work with them and so on and so forth. So in some respects that's the easy bit. Oftentimes, and not just in my current role, but in my previous life, and I'm sure John can chime in here, that the finance function isn't fit for purpose. And I hasten to add, that's not the fault of the incumbent finance professional, because oftentimes that person is just, the business has outgrown them, or they're just a place where they're out of their depth, and it's not to diminish the role that they've played in many times. And actually the fault really lies with the CEO of the business, who probably feels, sure, it's grand and it's fit for purpose, and I'm not spending any more on that function, and sure, I can do that anyway, and I'll make the calls, and sure, I can help manage the banks and so on, and that's all fine and well. But as the business scales, that you outgrow all of that too, and it comes home to roost. And whose comment was earlier, but at the point of the transaction preparedness, or at an M&A transaction, even worse, when there's a buyer at the door at the end of the journey, and I've seen, you've seen it, John, deals fall over through a weak finance function because the buyer just gets cold feet, or the digs room isn't properly populated, or the housekeeping hasn't been put in place. Time and again, it's not the problem. The business isn't the problem. So finance definitely, and then after that, it depends. It could be the sales function, it could be the operational side of the business, but the typical bugbear is finance, and it's where I think the kind of work you do, and having that in getting in early and helping shape companies for whatever the event is, whether it's an investment or a sale or even raising bank debt for the first time in an earlier stage company, I think it makes lots of sense.
And John, just in the context, when deal, the growth funding deal doesn't work, or if the funding gets in and the growth doesn't happen, what are the main inhibitors, or what tends to go wrong that it just doesn't happen as the vision had it when you started talking about the deal?
Yeah, for me, it's about picking the right partner, and you know all this. There's a lot of equity out there, so what Leo is saying, it's a partnership. So nothing is perfect. We all produce, as advisors, we'll produce our forecasts, and they'll all look nice. And what's guaranteed? Well, we won't hit those forecasts. Whether we'll outperform or we'll underperform, we don't know yet. But we certainly won't get the forecasts exactly. And in a case where the forecasts underperform, you want a partner with you that understands that and has been through the cycle a little bit. And every business is different. I reiterate about the finance function, and you guys can all play a part in that. Improving that, because that's when we get under the bonnet of a business in our preparation stage, that's what we're in there to say. Well, what's this? Whether it's a banker or whether it's an equity provider, they're all going to ask these questions. We need to get that right today. There's no point going to market before they're right. And whether that means you supplement the team with an interim finance function to come in and help out, that's what you do. And you have to do that if you're preparing your business for a funding event. So that's what I'd say. I think you have to have a good finance function, and preparation is always going to be key.
And John, I think that ties in with your advice from Enterprise Ireland, that it's often the finance structuring and capability is what.
It's always the finance function and capability. And what you'll often find is, companies who are beginning that journey, a lot of them already have a business plan done, quite sophisticated business plan, quite sophisticated management team, and they're almost trying to retrofit the finance and the projections back into the business plan to make it fit, where it should be one flowing from the other. So the financials should justify the business plan should be supported by the financials. I don't think anybody really thinks that strategically. You'd love them to, but I don't think anybody does. And I think that is probably the biggest issue that you would see at the moment. Just one note as well, and I think Leo mentioned it about having a strong chair there. We met almost 50 companies during International Markets Week, and all of the companies that were well prepared, and it was ironically it was around Brexit and the whole issue. We had about less than 20%, I'd say about 16% of companies were pretty well prepared in terms of their planning, their management, their finance function. All of them had a strong board. Every single one of them. They had an independent sitting there who was driving the direction, the strategic direction of the company, and the founder was being kept very honest by his board. So it's just something to note as well.
Excellent. So we had another question there.
Just for Leo again, sorry for all the questions. It's a breath of fresh air to hear some genuine equity in the room. The exit strategy, I mean, every funder has to have some eye to the door at some stage in the future. It sounds like this is going to go on forever, and it's just a capital growth for whenever the promoter comes out. Is that it?
Good question. So the short answer is we'll sell when it's the right time for the business to sell, and we'll sell with the founder. So we can't pull the founder into a sale, and the founder can't pull us. So that's the first point to make. So that's just the philosophical pact at the outset. Now, do we want to invest in a family business and say thanks very much for the money and this, and we're going to hand it on to the son and his son and forever and a day? That doesn't make economic sense for us, clearly. So we do a couple of things. Where we put our money in and take an equity stake, sometimes we deploy our money as loan notes as well as straight ordinary shares, and that is kind of a win-win in that we like getting some yield, fixed yield off our money because we're a balance sheet investor, and at the same time it minimises dilution because we don't do the old trick of doubling down on the loan note and the equity, and I'm sure many of you know that one. But so we don't do that. The loan note stand, if we put 10 in, 5 as a loan note, stands on 72 feet, 5 goes in as ordinary shares. At least so that's the first bit. But back to your point on the equity, we do have a clause which says at the end of year if nothing has happened by, let's just pick a number there, 7 years, okay, you'll start paying us a dividend over your head. Okay, that's the bargain, because you can't hold on to our capital forever. And you'll say, well, I don't like that. I say, it's fine, well then buy us out. Well, I don't do that. Well, put the company up for sale. Well, I don't do that. Well, then pay us a dividend. So the choice is always yours, but nothing's free. So we think that's about as fair as it gets. And of course, you'll haggle over what's the number, right, and what's the size of the dividend. And it's not intended to be, a gouge. It's just intended to keep a discipline on the thing. But that brings you all the way back to, but what did you agree at the start? So there does have to be some meeting of minds around exit at the outset. So if it's family business, we're never selling Ulsters, then it's a problem. We can, in extremis, put in a kind of a growth bond, as we call it, which is like a structured instrument with a warrant at the back end, and that's at the edges, right? And we typically like to have some alignment around exit. We can deal with a lot of ambiguity. It could be a case of we're probably sellers in around 5 or 6 years' time. We can't be sure. And it may be a case that the son or daughter is coming through, if it's a family business, and we'll take over the reins, at which point we'll make you an offer and we'll all act sensibly. So does that cover it? Yeah, thanks.
Any final questions? Right down in the back there, yeah?
Just a quick question for Jim. Sorry, as an old banker, I can't help but ask. You mentioned the 54% overturn ratio on decisions. If you took that as a portfolio, do you know how that loan book is performing?
Yeah, we do in that we do two things. One is we contact the borrowers who have secured funding with our support to see, first of all, is the phone still ringing, and how the business is going. That's one thing. The other thing is we ask the banks to provide us with the default rates on the portfolios that we have supported, and to date none of the banks have provided that information. Richie Boucher at one stage did publicly say that it was a high default rate, but when we asked for specifics, it wasn't provided. So the silence from the banks and the feedback we're getting from the customers who ring them up, it's very, very satisfactory. I mean, it's very, very satisfactory in our view. There's just one other source of funding which has not been availed of at all, and again it goes back to what Dr. Ray said in relation to having to be refused credit before you can apply, and that's a government credit guarantee scheme. And there's a government credit guarantee scheme there which was initially was quite limited, but it has been enhanced and changed recently and is now much more flexible and much more acceptable to banks as well. The banks didn't like the original one and they like this one. Well, not they like it, but they like it better than the other one. But give you an example of how it can be used. It's, for example, if you've got a really good company, strong cash flow but no security, and particularly if it's in a sector that the bank is not particularly familiar with, say the IT sector, then you can avail of the credit guarantee to secure the facility. In addition, what we're finding now is that if you've got, say, for example, an SME that has its loan sold to a hedge fund, and say they have a premises, now typically the minimum the hedge fund is going to look for is the value of the security they hold. The bank will lend 70% of the value, so there's a gap there of 30%, and provided the cash flow of the business is strong enough to support the lending equivalent to the value, then you can access the credit guarantee scheme to fill that loan to value shortfall. It's not been used to any great extent. It costs 2%, so for 2% of the additional margin on top of your loan. But it's very good, and it should be availed of. And again, it's the banks are not making customers aware that this is available for them. It's something to bear in mind for.
So I think a real opportunity for the advisory community to get that message out, because I suppose our view would be there's a high risk of a reasonable try at finding a recession in a growth economy where trading entities that happen to have property mortgages or whatever involved in the business structure will have vulture funds looking to realise their assets, and the trading entity and the jobs that Ray and his guys are trying to protect can go. So I think that kind of a guarantee facilitation of a refinancing is something that we all need to be sure that the awareness is out there. Listen, folks, sorry, one final question, and we will have, no one is running away, the panel is going to be sociable, so there'll be a chance for questions over the break or afterwards as well, yeah?
It's just for Jim, I suppose, just we had a case with the Credit Review Office recently, so I have to commend them how quickly it was dealt with and everything after a really slow no with the bank. But I think it actually touches on some of the points the other guys made about relationship with the banking information. There had been this constant request of information. The Credit Review Office actually brought it together very succinctly and quickly, and it's actually reinvigorated the relationship with the bank now. They've actually taken the client connection more seriously, and on top of the original money we put in the Credit Review Office, they're now adding 650 grand onto a funding application for it. So it's changed the dynamic totally with that. So it was actually just, I suppose, a good experience with them. And can I ask you a question, Pat? Seeing you've got a way So the guys talking about finance function, chairman, that type of thing. Is that something CAIM can offer as solutions to SMEs?
Yeah, so I suppose our core function, and guys like Barry Doyle and Bill O'Leary up front are probably more practiced than me, is essentially meeting this expertise and financial expertise gap. Is a lot of our members act as part-time strategic CFOs. So in other words, the guy that's there, the chief executive says sure, he's fine for the job, but he's not really. When the bank looks at the overdraft and you come under pressure, or you need an uplift, or there's a possibility of an acquisition, these guys step in and work for a finite number of days a month or a finite number of days on the assignment to work with the team, including the incumbent financial controller, to make the pain go away, or to make the good thing happen. So that's a key aspect, I suppose, of what the CAIM is about, is guys in business who want to go in and work with the companies on that strategic piece. Or the other piece, what a lot of us do, would be if you need basically a bit of restructuring and turnaround work. Often your accounting firm doesn't really have the capability of releasing a senior manager or a director for a couple of weeks or a couple of months to do it for you. So we work with the accounting firms where they'll refer one of our members out to do that piece of work, possibly at a margin, often just to get the client looked after, so that the audit firm continues to have a viable client and they don't have a problem with the audit and the ongoing stuff. So they're the two ways: the turnaround piece, or that strategic CFO to be used as and when required, so you're on variable cost as and when the revenue or the risk merits incurring that variable cost.
But not chairperson.
No, I mean some of our members, I think they'd be on the more mature end of our membership spectrum. The next logical progression for an interim manager is to take non-executive roles and chairman's roles. I took one and had to tell the guys that the business wasn't going to get licensed, so that one didn't last very long. But at least we saved them wasting a lot of money setting up a business that was never going to get a banking license for what I wanted to do. So we have instances of that as well. And we have guys on the kind of governance, risk, internal audit side that go on that more compliance and or what do you need to control the business from a regulatory perspective. Thanks for that question. I was hoping someone would ask me.
All right. Chris actually made a very valid observation there, which was, he said it had reinvigorated the relationship between the bank and the customer. And quite often we find the reluctance of people to use the credit review office is they feel that it will permanently damage the relationship with the bank. But quite often what actually happens is the local manager is supportive of the application, and then when his So the judgment is vindicated by the credit being approved. It does exactly what Chris has said. And I had a very funny incident recently where this customer of AIB's had been 6 months looking to get credit approved. It was declined on appeal. Came to the credit review office. We had a look at, we rejigged a few things, and we got it approved within 2 weeks, which was great. So a couple of weeks later, I got a phone call from the guy, and I said, "Is everything all right? Is that funding? Has it been a hitch or something? Is that why you're ringing me?" And he said, "No." He says, "The reason I'm ringing you is we actually got invited to the corporate box for the All Ireland semi-final."
So that's a quick. Listen, folks, I'm just conscious of the hour. We will be hanging around, so I just want to thank Virgil and the guys in the Byrne Wallace team for facilitating the joint event, and hopefully both our customer bases got a benefit out of it, and we look forward to doing some more in the future. So thanks very much everyone for your participation. Normally in the golf outings, you thank, when you're doing the prizes, you thank the catering staff, but given it's kind of late, I'm thanking them in advance for the treats they have for us now. Thanks very much.
I couldn't believe it. It's a pretty good ticket.